Neha works in an IT company and gets a good salary. She's young and doesn't have any responsibilities. That's why she is able to save a lot of money. She is bullish about the present and the future of the IT revolution in India. With that background, she invested a lot in tech mutual funds and expected good returns from it. And she did get good returns for a few years. But these funds have fallen in the last 3 to 4 months, and that has stressed Neha. Suddenly her fund started falling and she faced a loss of more than 20%. She had no idea what to do. Finally, she approached a financial advisor, Rohit Sharma. Rohit explained everything to her. Technology mutual funds fall under the equity mutual fund category and have been underperforming in recent months. As per value research data, the 3 months return are minus 20% in both equity technology mutual funds and S&P BSE IT Total Return Index.
Let's understand whether technology funds are appropriate for you. Let's start with what technology funds do. Sector mutual funds put all of their money into one sector. They have the potential to give returns that are higher than the benchmark, but they are also vulnerable to losses. They are best for investors who know a lot about risk. It's essential to know when to put money into these funds. Technology funds typically invest in shares of technology companies. Typically, they invest in developing technologies that have the potential to disrupt the industry with innovations.
The ICICI Prudential Technology Fund, SBI IT Funds, and Franklin India Technology Funds are some of the significant Indian technology funds. These fund houses have a portfolio in companies like Infosys, HCL Technologies, Tech Mahindra, and Mindtree. Most companies in these funds are focused on complex business challenges with innovative technological innovations. Examples include IT, digital transformation, data analytics, artificial intelligence, and machine learning. Sectoral funds are among the riskiest mutual fund categories because these funds invest solely in a single sector. They lack sector diversity, which is the primary cause of their high risk.
If the sector declines, the entire portfolio's equities will fall with no protection against the loss. These funds are only suitable for the most experienced and seasoned investors. Now the question is, what should investors like Neha or potential investors looking to invest in these funds do? No one knows where the market will move from here on. Recently, there has been a lot of volatility in the market. This has made things worse for investors. According to experts, the reason for the downfall in technology funds is that at present, they are in correction mode as in the past 6 months, their returns had shot up.
Vishal Dhawan, board member, Association of Registered Investment Advisors ARIA says, considering that technology mutual funds are sectoral funds, aggressive investors who are comfortable with significant volatility associated with sector funds should only be invested here. Technology funds went up very sharply and have now corrected, which by itself should not be the reason to exit, as long-term investors can gain from this specific sectoral exposure if they are comfortable with the volatility of sectoral funds.
So if you want to invest in technology funds, you should pay close attention to how the funds have done over the last 3 years. Also, you need to know a lot about the technology industry and its potential market. Since these funds mostly buy stocks, they can be volatile in the short term. But if investors stick for a long time, the risk declines significantly.